The goal for most of us investors is pretty simple, right? We want our stocks to do more than just sit there. We want them working for us, generating income. And a really popular way to do that is with a covered call. It's often sold as this safe, steady way to earn extra cash. But what happens when that safe strategy runs headfirst into a stock that's absolutely taking off?
I mean, you can just feel the pain here. You've seen it happen. You sell a covered call on a stock like SoFi, feeling pretty smart about pocketing that premium, and then you watch with this cold sweat as the stock just keeps going up. It's on an absolute tear. Maybe it's up 9% in a single day, and suddenly that safe little income play feels like a gigantic missed opportunity.
And that's the big question we're going to tackle in this explainer. Did you mess up? Is the strategy itself broken? Or is this feeling just part of the game? To really figure that out, we need to take a step back and understand exactly what kind of trade you put on in the first place. So before we can even begin to answer our trader's dilemma, we have to go back to basics. Let's break down the fundamentals. What exactly is a covered call? Okay, so here's the deal. It all starts with something you already have in your portfolio, at least 100 shares of a stock. Then you sell a contract, what's called a call option against those shares you own. And for doing that, for selling that contract, you immediately get paid a cash fee. We call that the premium. And here's the best part. That cash, that premium, is yours to keep, no matter what happens next. But, and this is a big but, there's always a trade-off, right? As the seller, you get that sweet premium, but you also take on an obligation. You've just promised to sell your 100 shares at a specific preset price, that's the strike price, if the person who bought the option from you decides they want them. See, the buyer on the other side of your trade, they're paying you for that power, the right but not the obligation to buy your stock at that strike price anytime before the contract expires.
So you've essentially traded a promise for some cold, hard cash. But what does that actually look like for your bottom line? Let's run through a couple of simple scenarios just to see the math in action. All right, let's run the numbers. Imagine you buy 100 shares of, let's call it XYZ stock, at $50 a share. You then sell a call option with a strike price at $55, and for doing that, you collect a $4 premium. Now, let's say the stock just skyrockets to $60. Well, the buyer is definitely going to exercise their option, and you'll be forced to sell your shares at $55. So you made a $5 gain on the stock itself, plus you keep that $4 premium. That's a $9 profit per share, an 18% return. Hey, not bad at all. But you did miss out on that extra $5 of upside, all the way to 60.
Okay, but what happens if things go south? Let's say the stock takes a nosedive down to $40. In that case, the option expires worthless. I mean, nobody's going to buy your shares for $55 when they can just go get them on the open market for $40. So you keep your shares, but they've lost $10 in value. The silver lining? You still have that $4 premium you collected at the very beginning, so your net loss is only $6 per share, not 10. That premium acted as a little bit of a cushion. So when you strip it all away, that's the deal you're making. The pros are pretty clear. You get immediate income, and it offers a little bit of downside protection if the stock dips. But the cons are just as clear. You have completely capped your potential profit, and that little cushion isn't going to save you if the stock really crashes. You're basically taking on most of the risk of owning the stock, but you've agreed to a limited reward. So given that trade-off, you can probably guess that selling covered calls isn't something you should just do all the time. It's a very specific tool for a very specific job. Let's shift gears and look at this from a strategist's point of view and figure out when this play is actually a smart move. So, when is the right time to pull this trigger? Well, this strategy really shines when you're feeling kind of neutral or maybe just a little bit bullish on a stock. You're not expecting it to rocket to the moon, but you don't think it's going to crash either. It's a fantastic way to squeeze some extra income out of a stock you're planning to hold for the long term. Or, and this is a great one, if you already have a price in your head where you'd be perfectly happy to sell anyway. Okay, now I want you to stick with me here because this is where things get really interesting. Back on the old trading floors, they had a saying to get the new traders to think outside the box. They'd say, calls are puts and puts are calls. It sounds like some kind of weird riddle, but it actually points to a much, much deeper truth about risk. So what in the world does that even mean? Well, check this out. A covered call has the exact same risk and reward profile as a totally different strategy, selling a cash-secured put. Now, most people think of covered calls as conservative, and they think selling puts is risky.
but financially speaking, they are identical. The safety you feel from a covered call is often just a psychological trick. Point is, if you're okay with the risk of one, you should be okay with the risk of the other. All right, so we've covered the what, the why, and the when. Now it's time to get into the nitty-gritty, the how. What are the actual steps to place the trade? And, maybe just as important, how does Uncle Sam view your profits? The good news is, executing the trade itself is pretty straightforward on most modern platforms. So if we use SoFi as our example, you just find the stock you own, head over to the options chain, pick the call contract you want to sell, that means choosing an expiration date and a strike price, and you hit sell. The one key thing to remember is you must already own at least 100 shares to make it a covered call. And of course, we gotta talk about taxes. If the option you sold just expires worthless, it's simple. That premium you collected is treated as a short-term capital gain. Easy enough. But if the option gets exercised, the premium you received gets added to your stock's sales price. So in our example, if you sold your shares at the $55 strike and got a $4 premium, your sale price for tax purposes is actually $59, and that's what you'll use to calculate your capital gain on the stock. Okay, so now we have all the pieces of the puzzle. We've got the mechanics, the strategy, the execution details. Let's go back to our trader who's watching SoFi rocket upwards and is really feeling the pressure. So you're looking at your screen. Your call option is now what we call in the money. That's just fancy talk for the stock price blowing right past your strike price. At this point, it looks almost certain that your shares are going to be assigned or called away from you when the option expires. So, do you just sit on your hands and watch it happen, or is there a move you can make? When you get right down to it, you've basically got three main plays here. Number one, do nothing. Just let your shares get called away at the strike price. You accept your capped but still profitable return. Number two, you can try to roll the option. This is where you buy back the call you sold and then sell a new one at a later date, hopefully for more money than you spent. Or number three, you can just buy back the call option to close the whole thing down. You'll take a loss on that option trade, but it frees up your shares to keep riding the stock higher. And you know, this is where the psychology of trading really kicks in. It's all about discipline. Chasing a stock that's running away from you, rolling your option again and again for just a few extra pennies, that can be a losing game. Sometimes, the smartest move is to do nothing at all. Let the shares go, book the profit you originally planned for, and move on to the next trade. Which brings us right back full circle to the fundamental question of this whole strategy. A covered call is, at its heart, a trade-off. You are intentionally swapping the chance for an explosive home run gain for a steady, predictable drip of income. Whether that's a good trade or a huge mistake, well, that depends entirely on your own goals, your own discipline, and your personal answer to this one question.